Good day, welcome to this class. If this is your first time on this channel, please click the red subscription button to subscribe to this YouTube channel so that when we drop more educative content, you get notified. Now, as you can see on the board, today we'll be treating another very interesting topic, which is called budgeting. Now, you need to know that budgeting is a very broad aspect of cost accounting or management accounting. It's very broad. And when we talk about budget is a financial plan for another fiscal year. What do I mean by a financial plan for another fiscal year? Budget can be for next year, can be for next month, can be for next 2 months. Now, why do we have to prepare budget? We have to prepare budget because we need to plan our operations ahead. If we don't, there's no way we can test if we're actually meeting our goals. There's no way we can see if you're actually progressing. And these are the major reasons why we prepare budgets. But I don't want to go into the theory aspect. I want to go into the calculation aspect where it I feel will give most of us problem. And we need to understand that there are different kinds of budgets. Now, there is the functional budget, there's functional budget, there is the cash budget, there is the master's budget. Now, of all these budgets, I will for this class I'll dwell on this cash budget. Then in our next class we can look at the functional budget, the master budget. We can even I will even teach how to prepare what we call um a flexible budget. Yeah, there's a flexible budget. I will teach that, but in our subsequent videos. So when we talk about a functional budget, you need to know that in an organization there are different departments. There's the production department, there's the sales department, there's the marketing department, the HR department, and lots more. Now, anytime we make a budget for any of these departments, we call it a functional budget. So when you make a budget for the production department, you want to know how many units will be produced for next year, how many units do you have available, how many closing stock do you want to have in units for next year. So you are making budget for the production department, and that's a functional budget. Now, a cash budget is more or less like a budget that nets your inflows of cash with your outflows of cash. What do I mean by your inflows of cash? The money that is coming in and the money that is going out. It can be for future. Cash budget can be for future or what has happened in the past. You might want to see, okay, for the past 3 months, we have a cash of a net inflow of 1 million. Is that supposed to be? Okay, let's prepare a cash budget. Let's see how much do we receive, how much do we pay out, this and this. Then is that the amount we are meant to have? So cash budget can be historical and at the same time can be futuristic. So we have the master budget. Let me use Nigeria for example now. If Nigeria's budget is to be prepared, there's something that will be sent out. And what's that thing? We call it a budget circular. Now, what's a budget circular? A budget circular is a document that is sent by the Minister of Finance to every ministries, every corporations. Now, it's similar to that of functional budget. And what does that budget circular implies? It means that every ministries, Ministry of Education, Ministry of Aviation, Ministry of Agriculture, Petroleum, etc., they should all prepare their budget. Now, when they prepare their budgets, don't forget that that's similar to functional budget, because functional budget is a budget of department in an organization, right? So when they prepare all those budgets separately, they will now bring them together, incorporate them into a full one. That full one is what we call the master budget. It encompasses everything, and that full one is similar to Nigeria's budget because yes, it encompasses everything, the whole ministries, the whole everything totally. So, like I said, I'm not going to dwell much on this theoretical part. We'll go into preparing a cash budget. Now, when we want to prepare a cash budget, organizations need that. It's different and it's different from cash flow statement. Yeah, cash budget is different from a cash flow statement. There are two different things. So we look at our net inflows probably for the future or for the previous years or for the previous month, and we compare it with our outflows. We can use it to make any decisions we want to make. So let's go. Let's see how we can prepare. Let's take a question and let's see how we can prepare a cash budgeting for a particular year. Thank you. Halaj Dutton Chemical Limited is a newly established company supplying chemicals for farming. The following information relates to the company activities. So we're given the month, material purchase, sales, wages incurred, overheads. So we're given all the activities information from January to August. January, February, March, April, May, June, July, August, as you can see. So we're told that the following details are also relevant. Expected cash balance on April 30th will be 11 million naira. Debtors are expected to pay 2 months after delivery. Wages will be paid within the month they are due. 4. It is the company policy to pay creditors for the material purchased 3 months after receipt. Fine. 5 rather. There is a month delay in paying the overhead expenses. 6. Included in overhead amount is 1 million naira representing depreciation on motor cars used for delivery. 7. It is expected that 10% of the monthly sales are for cash while 90% are on credit. 8. The company is expected to repay a loan of 12,500,000 at the end of May. 9. The two machines costing 22,500,000 are acquired in June, out of which 7,500,000 will be paid on delivery and 7,500,000 in each of the succeeding months. Now, a commission of 5% is paid to agents on all sales on credit during the month following the sales, which is related. Now, this is the question we have been told, and we are required to prepare the cash budget for each of the months of May, June, and July using a communal format. Show workings. Yes. So we are going to be showing workings on how we are going to prepare a columnar cash budget. So we go cash budget for the month of May, June, and July. We have May, June, and July. So, so these are the 3 months we have. So the first thing you need to realize that whenever you're preparing a cash flow, whenever you are preparing a cash budget rather, there's always an inflow and there's always an outflow. So you need to consider your inflow alongside you consider your outflow. And there's always a starting balance. What do I mean by a starting balance? If you're preparing the cash budget of every month, at the month of April, there should be a cash balance we are ending the month with. Maybe after at the month of April, after paying our expenses, generating our revenue, we are left with a cash balance of 200,000. That cash balance is what you are going to use to start the month of May. So from the beginning of the question, they told us that expected cash balance on April 30th will be 11 million. So that's the balance brought forward. The balance from last month being carried down to this month. But the first thing you need to do, there are different formats, different ways to go about preparing this. But I'll teach you guys, trust me to teach you guys the one that is the very, very simple and very straightforward. So you start with the inflows. You look at the inflows. What are the activities that will bring money into this business? Those are the things you first recorded. Then you now go to your outflows. So let's start with our inflows. If you're starting with our inflows, let's see this way. We have inflows. Inflows. So the first item we have expected cash balance on April 30th will be 11 million. That's not an inflow, that's an opening balance. So let's leave that for now. Let's leave it for now. We'll come back to it. So the third, debtors are expected to pay 2 months after delivery. Now, debtors are expected to pay 2 months after delivery. Now the question is, before you can solve before we can start doing this on the board, we need to know if there is any other information relating to debtors. The information we have been told is that debtors are expected to pay 2 months after delivery. Is there any other information relating to debtors in this question? Let's look at it. If you look at question 7 rather, it says it is expected that 10% of the monthly sales are for cash while 90% are on credit. So sales 10% is for cash and 90% is for credit. Right? This is an information that is relating to debtors that we need to consider in this question. So, of every sales we are making, 10% is cash, 90% is credit. And we're being told that debtors are expected to pay 2 months after delivery. So, that means that after debtors have been delivered the goods, they will pay 2 months after we have, we are selling 10% of our sales to them in cash. That means they're going to pay immediately, and 90% they will pay 2 months after. So, that means that this 90%, let's start with our inflow. Let's start with our sales now. We have our sales. Now, let's deal with these sales first. For the month of May, for the month of June, for the month of July, what is our sales? For the month of May, our sales is 35,000 naira. So for the month of May, our sales is 35,000 naira. And you all agree with me that 10% of 35,000 naira will be 3,500. So 10% of our sales is 3,500 for month of May. And for the month of June, our sales is 30,000 naira. 10% of that will be 3,000 naira. And for the month of July, our sales is 25,000 naira, and 10% of that is 2,500. Now, if the amount, don't forget that 90% of our sales is on credit and it will be paid 2 months after. What does that mean? That means that the 90% of the whatever is left out of May sales will be paid in July. Please, are you with me? Because 10% is on sales, and they told us that they give us information that 90% that is on credit will be paid 2 months after. So if I'm making a 10% sales and I'm collecting 10% of my sales in May, and I'm going to be collecting it, the remaining cash, 2 months after, that means I'll be collecting the cash balance of this debtor in July. If you follow the information, the question we have been solving very well. So that of June, we'll be collecting it, will be that of April, we'll be collecting it in June, because April, 2 months after April, May, and June. So March, that of March, we'll be collecting it in April, because March, after March, March, April, May. So what does that mean? That the balance, whatever sales we are selling in March, 2 months after it is what we are going to be collecting the 90%, which will falls in June. So you need to critically analyze cash budget question, because they can come tricky. So now in this situation now, one will have think maybe the other month that is not May, June, July, you don't need their information. But look at it, it turns out that you need it, because for us to be able to get the remaining debtor balance here now, debtor balance, let me just put it as debtor. So 90% of whatever we sold in March will be paid in June. So March, April, May. We paid in May rather. So let's go. What's our sales in March? Our sales in March is 30,000. So 90% of 30,000 will be 90% of 30,000 will be 27,000. So this will come here 27,000. Now for month of June, whatever 90% of whatever we sold in April will be collecting in June, because April, May, June, 2 months after, 90%. What did we say? What's our sales in April? April is 25,000. That will give us 22,500. So for the month of July, whatever 90% of whatever we sold in May will be collected in July. So what's our sales in May? Our sales in May is 35,000 naira, and 10% of 35,000 naira is 35. So if 10% is 35, so 35,000 minus 35 will give us our 90%, right? So 35,000 minus 35, that's 31,500. So I'll be left with 31,500. So you see the analysis that it's quite like logical. So you need to critically analyze questions in cash budgeting, because so that you will not think you are getting it meanwhile you are missing it. So let's go to the other information and let's see what it has for us. Let's see if you have any other inflow that we're going to be recording. So we're told that wages will be paid within the month they are due. Wages is an outflow. It is the company policy to pay creditors. To pay creditors, that's an outflow. There's a month delay in paying overhead expenses. That's an outflow. Including the overhead is one. That's an outflow. It says well that 10% of the sales are okay. We've done that. The company is expected to repay a loan. Outflow. Two machine costing. Outflow. So every other thing that we have on this information, they are all outflows. So these are the inflows we have in this question. So what do we have to do? We need to sum them up. So if we go, we sum them up. We have, how much is this? 35 plus this will give us 30,500. This will give us 22,000, 25,500. This will give us 34,000. So now this is the total. So we have, let's call this total, and we have, let's address it as A. So we close our cash inflows. So now this is all our inflow that we recorded from this question. The next thing we need to consider is our outflows. So what are our outflows? How much is our outflows? So let's go. We have outflows. So how much is our outflow? Let's look at the question. Go back to the question and record our outflow value. Now they told us in the question that from starting from additional information 3, Wages will be paid in the month within the month they are due. So the month the wages are due is the month you are going to pay the wages. So what does that mean? That means that the wages of May will pay it in May, wages of June will pay it in June, wages of July will pay it in July. So let's go. What's the wages of May? If you go back to the question, wages of May is 6,000 naira. Wages of June is 5,000 naira. And wages of July is 4,500 naira. So let's go to the next additional information. It is the company policy to pay creditors for material purchase 3 months after receipt. Now, it is the company policy to pay creditors for material purchase 3 months after receipt. That means that whatever material we purchase, we are going to pay 3 months after. Now, if that's the case, that means that um material we purchase in January will be paid in February, March, April. We will be paid in April. Materials we purchase in February will be paid 3 months after, which is February, March, April, May. So materials we purchase in February will be paid in May because I said we are going to pay for any material we purchase 3 months after. So material we purchase in February, how much is it? We purchase material purchase in February is 12,500. So creditors, let's put it that way. Materials we purchase in February will be 12,500. Now, materials we purchase in March will be paid in June, 3 months after. So, material purchase in March is also 12,500. 12,500. And material purchase in April will be paid in July, 3 months after. April, May, June, July. So, April is 17,500. So as you can see, we have calculated all our total inflow. Now we are calculating our outflow. Then we net it. Whatever we have is our net cash flow. So now we go to the next one, which says there's a month delay in paying overhead expenses. That means that there's a month delay. This thing is just English interpretation. That means overhead of May will be paid in June. Overhead of June will be paid in July. So now which month overhead will be paid in May? So we go overhead. Which month overhead? If there is a month delay in paying overhead, definitely overhead of April will be paid in May because there is a month delay, 7,000 naira. So overhead of May will be paid in June. Overhead of May is 9,000 naira, and overhead of June will be paid in July, which is 8,000 naira. So cash budgeting just requires you to understand what the question is saying, then put it for them the way you understand it. It's as simple as that. Next additional information, they told us that included in the overhead amount, don't forget that this is overhead. Included in this overhead that we have written down is 1 million representing depreciation of motor cars used for delivery. Now, one thing you need to know is that depreciation is not a cash budgeting item. In fact, when you are preparing cash flow statement, IS 7, you don't include depreciation. Why? Because depreciation does not involve actual movement of cash. So the fact that it does not involve actual movement of cash, it is a non-cash item. So it will not reflect anytime you are preparing anything, cash budgeting, cash flow, anything, depreciation will not reflect. So we were told that in this amount, don't forget that everything is in million. I forgot to put 30 at the top. So included in this amount that we've recorded for overhead is 1 million naira that serves as a depreciation expenses. So what do we have to do that? We have to subtract it because depreciation is a non-cash budgeting item. You don't include it because it does not include actual movement of cash. It's just an estimate. So we don't include it. So what do we have to do? We need to net off this amount of overhead by 1,000 naira, which is 1 million naira each. So if you net off 1,000 naira from this, you have 6,000 naira. Net of the same thing, you have 8,000 naira. Net of the same thing, you have 7,000 naira as your overhead because you removed the depreciation item. Let's look at the next additional information. The next one told us that it is expected that 10% of the monthly sales are for cash. We've treated that. That's even what we started with. The next one says that the company is expected to repay a loan of 12.5 million at end of May. Now, we want to repay a loan at the end of May. That's a cash item, but because there's an outflow, that's an outflow item. So we come here, loan. Now, this loan is only peculiar to the month of May. Because it's peculiar to the month of May, how much is it? 12,500. So nothing here because yeah, we are not repaying a loan in June and July, just for me. So the next additional information says that two machines costing 22.5 million, which is 22,500, are to be acquired in June, out of which 75 will be paid on delivery. So we are going to pay money for machines in June. So we will go machines. We are not paying for machines in May, but we pay for machines in June, which they said 7,500 will be paid on delivery and 7,500 in each of the succeeding months. So what does this mean? 7,500 in each of the succeeding. That means subsequent month after June, July, we will continue paying 7,500 till we exhaust that amount. So of course we are going to pay 7,500 here again, but nothing here. Now, if you look at that, they now told us lastly, the last additional information, that a commission of 5% is paid to agents on all the sales on credit during the month following the sales to which it relates. So what does this mean? It means that commission, 10% of our commission is paid to our agents. For example, if this is month of May, they are going to be paying commission of May in June to our agents. So what does that mean? That means that commission of April will be paid in May, commission of May will be paid in June, commission of June will be paid in July. So that's what it means. Let's read that question very well. That additional information. A commission of 5% is paid to agents on all sales on credits. So we need to take note that the sales we are going to be paying commission on is only on credit. Don't forget that 10% of our sales is cash, 9% of it, 90% of it is credit. So for the month of April, what is the value of our sales? For the month of April, the value of our sales is 25,000 naira. Is 25,000 naira. Now, 90% of 25,000 naira, 10% of it is 25. So of course, 90% of it will be 25,000 minus 2,500, and that will give us 22,500. So this is the 90% of our sales in the month of April. So if this is 90% of our sales in the month of April, then of course 5% of it will serve as commission that will be paid in the month of May. So 5% of 22,500 will give us 1,125. So commission, so 1,125 naira. Now, our sales in May, of course, our sales in May, if you go back to the question, our sales in May is 35,000 naira. So 90% of it is on credit. So 90% of it, 5% of the 90% is what will give us the amount we are going to pay in commission in the month of June. So if you do that, you'll be having 1,575 naira, 1,575 naira for the month of June. Now, sales of June, 90% of the sales of June, then 5% of it's just like sales of June. Let's do a practical example so you get what I'm trying to say. Is sales of June is 30,000 naira. Now, if sales of June is 30,000 naira, then 90% of it is whatever we are going to be paying the commission on. They told us that the commission will only be paid on the 90% of the sales. So times 90% at first, then we are only paying 90% of 30,000. We will only be paying 5% of it as commission times 5%. So in this way, you will get the amount that will come as your commission for July. And if you do that, you should be having 1,350. 1,350. So which amount for the totality of our outflow. So this is our inflow, this is our outflow. So let's sum this up. If you sum all your outflows together, if you add all your outflows, 6,000 plus 12,500 plus 6,000 plus this, you get 38,125. So the total of my outflow is this, total of my outflow is this, total of my outflow is this. Don't forget that my total inflow is this value that we have here. So we need to get our net inflow. And how do we get that? By subtracting our inflow from our outflow, or our outflow rather from our inflow. So we go. And don't forget that our total outflow, we called it A. Total inflow, we called it B. So net inflow now will be A minus B. So A minus B will give us my total inflow minus my total outflow. Now 30,500 minus 38,125, that will give us 7,625 as our net inflow. But it's a negative amount because this 30,500 is sure due lesser than this. So it's a negative amount. So we have 7,625. So as that, we have 7,625. The second one, 25,500 minus 34,700 and 557. That will give us 9,075. Also a negative balance. Then lastly, we have 34,000 naira minus 37,850. That will also give us a negative balance of 3,850. 3,850. Now, this is the total of your inflow from your subtracted from your outflow. But don't forget that at the beginning of the question, we were being given the opening balance of April. Don't forget that I said the opening balance of month before May. Sorry, the closing balance of April will start as the opening balance of May. So there's something we need to do now. The opening balance of April, how much is it? Let's go. The closing balance of April, rather, will serve as the opening balance for May, and which was given at the beginning of the question that the closing balance of April is 11 million naira, which is 11,000 naira. So we've gotten the total for all our outflows, which is 38,125. Gotten total for all our outflow for June and July, and we subtract the total inflow from total outflow, giving us a balance of 7,625, 9,075, and 3,850. So how do we treat the opening balance that we have? This is how we treat it. Since the opening balance is 11 million, so we bring it here, 11 million. We are going to add it to this balance that we have here. So we have opening balance of 11 million. We just say balance brought forward of 11 million. So if we subtract this 7,625 from this 11 million, we get our leftover balance. That our leftover balance will be our opening balance for this month because this is our closing balance. So minus 7,625 subtracted from 11,000, we have 3,375. So this is our closing balance for the month of May. It will serve as our opening balance for June. So our opening balance for June is 3,375. We bring it here, 3,375. And don't forget that our balance for June, our main balance for June is having a negative balance, which is 9,075. So we subtract and we take note of the effect. If we had negative 9,075 plus 3,375, we have negative 5,700. So this is our closing balance for the month of June, and it will serve as our opening balance for the month of July. So negative 5,700 as our opening balance. So if we do the effect, we had minus 3,850 minus 5,700. That gives us a total of negative 9,550. So this cash budget has shown the inflow that we have for the month of May, June, and July, and the outflow and our leftover balances for each respective month. So we've come to the end of this class. In our next video, we'll talk about the other aspect of budget, the functional budget, production budget, flexible budget, and lots more. And you can't afford to miss it. Please click the subscription button. I'll see you right in my next video class. Thank you.